The market looked like a barren wasteland. News barely moved the needle. Price charts drifted lazily, as if everyone had already given up. But beneath the surface, a massive gold vein was quietly forming. Most people only saw the dry, cracked ground, nothing but rocks and dust. Only a few knew how to read the map, to recognize the subtle signs that a treasure was waiting to be found. Massey was one of them. He didn't grab a shovel and follow the crowd, digging in the same old exhausted mines. He quietly searched, narrowed his focus, confirmed his theory. And then, before the world even realized what was happening, he struck the gold vein. One name everyone now knows, NVDA, turning it into millions, not after the hype, but before it even began. Imagine yourself spotting the next NVDA before the headlines. Picture opening your account to see gains that took months to build, not because you got lucky, but because you saw what others missed. Feel that confidence of knowing your position before the stampede arrives. Welcome to Trading Psychology Stick, where we decode the mental game behind profitable trading. Quick note, everything I share comes from real market experience and public information. This isn't financial advice. It's education on reading market narratives. Your capital, your decisions, your responsibility. This isn't just the story of a single stock. This is the story of a method, how to find the market's gold vein, a narrative, and mine it before it becomes front-page news. You don't have to be a long-term investor to do this. Swing traders can ride the middle of the stream. Day traders can capitalize on the intraday waves of a forming narrative. The key is knowing how to spot it, believe in it, and mine it at the right time. In the next hour, we're going to unfold Massey's map, learning how to read the signals the crowd ignores, combining deep research with technical precision to know when to pick up the shovel and when to walk away. If you've ever felt like you're always late to the party, jumping in when the gold is almost gone, this video will change how you see the market. This isn't dry theory. These are real strategies, proven in real trades from NVDA to Tesla to the explosive rise of AI sectors. And when you understand how a narrative moves across multiple time frames, you won't just make profits. You'll learn how to stay ahead of the crowd, whether you're digging deep or striking fast. Get ready. We're about to go deep underground, where the narrative gold vein waits for those sharp and patient enough to find it. Chapter 1. The trade that shocked Wall Street. It started quietly. NVDA was trading like just another tech stock, respected, but hardly the center of the market's attention. The headlines were elsewhere. Analysts were busy dissecting the latest drama from big banks or the macroeconomic noise coming out of Washington. But while everyone's eyes were on the surface, something was brewing deep below. Massey had been watching, not just the price action, not just the earnings reports, but the story behind the numbers. In his mind, he wasn't looking at a ticker symbol. He was studying a plotline, a living narrative that was about to enter a new act. The AI revolution wasn't yet a buzzword in every household, but the signs were there, in patent filings, in obscure industry conference talks, in the hiring patterns of certain engineering teams. These weren't the things you'd find on CNBC. They were buried, like faint glimmers of gold dust in the dirt. When the market finally began to stir, it was subtle. An uptick in volume here, a sudden influx of institutional buying there. The stock moved from 108 to 115 over 3 weeks. Nothing spectacular. But while others dismissed it as random noise, Massey saw the first strike of his pickaxe against the vein. His research had already built the conviction. The price action was simply confirming what he already knew. This is where most traders make their first mistake. They wait for the gold rush before they start digging. By then, the easy gold is gone. Massey was in before the rush, positioning himself while skepticism still ruled. The moment of shock came months later, when NVDA's earnings report didn't just beat expectations, it obliterated them. Revenue jumped 265% year over year. The stock gapped up 24% overnight. Headlines screamed about the AI boom. Retail traders piled in, and the stock ripped higher in a frenzy. But for Massey, the real victory wasn't the price spike. It was the calm certainty that he'd been right all along. He wasn't chasing the move. He was already deep in the mine, pulling out gold while others were still scrambling for shovels. This is where the first lesson emerges. A narrative edge isn't about predicting the exact day a stock will explode. It's about positioning yourself before the crowd even believes there's something worth chasing. Whether you're a swing trader holding through weeks of quiet buildup, Or a day trader looking for that one explosive session when the story hits the wires, the edge is the same? Get in before the story becomes a headline. But that begs the question, how do you see the gold vein before the crowd? How do you know which flicker of information is a real signal and which is just fool's gold? We're about to answer that, and it all starts with understanding what the crowd consistently misses. The crowd always looks in the same places: earnings calendars, analyst upgrades, trending tickers on social media. It's like a mob of prospectors all swinging their picks in the same dirt pile, fighting over scraps. They're so focused on the obvious that they don't notice the faint glint in the corner of their eye, the one that could lead to a whole new vein. In the months before NVDA's breakout, the market consensus was simple. Tech was tired. Rising interest rates were squeezing valuations. Semiconductor stocks were cyclical and unpredictable. Every talking head on TV seemed to echo the same tune. There were safer places for your money. And so, while the crowd was busy chasing the latest meme stock or reacting to yesterday's news, the real story was unfolding quietly, in places most traders never looked. Feel that frustration when you realize you've been looking at the same screens as everyone else? That's exactly where Mossy was different. He wasn't trying to keep up with the crowd's pace. He was moving at his own. Instead of reacting to the latest analyst downgrade, he was watching a slow but steady shift in the underlying fundamentals. New government contracts for AI infrastructure worth $4.5 billion. Industry supply chain adjustments signaling future demand spikes. Software companies hiring GPU specialists in droves, job postings up 340% quarter over quarter. Each piece on its own looked insignificant, but together they told a story the crowd couldn't see. This is the heart of information arbitrage, seeing the connection before the majority. The crowd waits for someone else to tell them the story. Mossy builds it himself. And because he's the author of his own narrative, he gets to act before the plot becomes public knowledge. For swing traders, this is a massive advantage. It means you can enter weeks or even months before the rest of the market catches on, riding the initial lift that happens when institutional money quietly starts positioning. For day traders, it means you can recognize the day one moment, when the story finally hits mainstream, and catch the most explosive part of the move before it fades. But the irony is, spotting what the crowd misses isn't about having faster news feeds or more screens. It's about slowing down enough to see the patterns others overlook. It's knowing where to look when everyone else is staring somewhere else. Think about it. When was the last time you found a profitable trade by doing exactly what everyone else was doing? If you're nodding, type yes in the comments. If you've never thought about it this way, type learning. This isn't about being contrarian for the sake of it. It's about seeing the full picture while others fixate on fragments. Still, spotting the story is only the first step. The real challenge is believing in it enough to act, especially when the price action hasn't caught up yet. And every tick against you makes you question if you've been fooled. That's where conviction comes in, and Mossy treats it like the most valuable tool in his kit. Chapter 3. The Birth of Conviction. Conviction doesn't come from staring at a chart until the candles start to whisper. It's forged in the grind, hours spent digging through filings, tracking industry shifts, piecing together information that nobody else has taken the time to connect. For Maisie, conviction is the miner's permit, the document that says, "I've done the work, I know where the gold is, and I'm ready to dig." Before the NVDA trade became legend, Mossy had already put in hundreds of hours on the story. He didn't just skim quarterly reports, he dissected them. Line item revenue growth in data center segment, up 41% when everyone focused on gaming, down 46%. He followed supply chain trends, analyzed government spending plans totaling $52 billion for AI infrastructure, studied job postings for clues about future product lines. He listened to obscure conference calls that most traders couldn't be bothered with. Every piece of data was another clue, another coordinate on the map that would lead to the vein. Not hope, not gambling, but calculated confidence built on evidence. Picture holding through a minus 15% drawdown without breaking a sweat because you know something the market doesn't yet see. That's the power of research-driven conviction. The thing about conviction is that it doesn't just tell you where to dig. It keeps you digging when the first few strikes hit nothing but rock. For swing traders, that means holding your position through the dull days when the market moves sideways, knowing that the story hasn't changed. For day traders, it's the discipline to wait for your setup on the day the story breaks, instead of chasing every flicker of momentum. Conviction is what lets you filter the noise, ignore the false alarms, and focus on the moment the market finally wakes up to the truth you've known all along. Most traders confuse conviction with stubbornness. They think holding on to a losing trade is a sign of strength. But conviction isn't blind loyalty. It's informed patience. It's knowing exactly what would make you abandon the trade and recognizing that until those conditions appear, the plan stands. Massey had those lines drawn before he entered NVDA. If the core of the narrative shifted, if demand projections crumbled, if technological breakthroughs stalled, he'd walk away. But as long as the story kept building, he stayed in the mine. This is why conviction is more than a feeling, it's a shield. When the price dipped 5%, 10%, even 18% before the run, others panicked and dumped their shares. Massey stayed, not because he's fearless, but because he'd already decided, based on evidence, that the gold was there. And when you have that kind of conviction, market noise becomes just that, noise. But conviction alone isn't enough. Even if you know where the gold is, you still need to decide how to mine it. And that's where time frames become the difference between a steady, methodical excavation and a fast, aggressive strike. The narrative can run across all of them, but only if you understand how it moves. Chapter 4. Narrative across time frames. A great story doesn't just live in one moment, it unfolds in chapters. The same is true for market narratives. A catalyst might spark a reaction in minutes, ripple through days, and then swell into a trend that lasts for months or even years. Understanding how that wave travels through different time frames is how you decide whether to bring a pickaxe for a quick strike or heavy machinery for a long dig. When NVDA's AI story began to take shape, the earliest tremors were felt on the intraday charts. A sudden pop in volume, 3 times average in the first 30 minutes. Unusual options activity, call volume spiking 450% above normal. Headlines tucked away in niche tech blogs. Day traders who knew what to look for could ride those first jolts, flipping positions in hours and walking away with quick profits of 3 to 5%. But while the crowd was celebrating a one-day win, Massey was watching the bigger picture form on the daily and weekly charts. Patterns that said, this wasn't just a passing headline, it was the start of something bigger. Feel yourself zooming out from the 5-minute chart to the weekly. See how the same story looks completely different depending on your lens. The panic on the 1 minute becomes a blip on the daily. The breakout on the hourly becomes the first candle of a months-long trend. Which view serves your style better? Swing traders, like patient miners, know that the richest gold often lies deeper underground. The initial surface nuggets, the intraday pops, are exciting, but they're just the hint of the vein below. By studying how the story behaves across time frames, you can plan your entry like a staggered expedition. Start small when the first signs appear. Add size as the market confirms the narrative. Hold through the noise when you know the deeper layer hasn't been tapped. The mistake most traders make is locking themselves into one lens. Day traders ignore the weekly chart and miss the underlying trend. Swing traders ignore the intraday action and miss the perfect entry or early warning signs. Massey bridges that gap. He understands that the narrative isn't static. It's a living thing that breathes differently depending on the time frame you're looking at. For day traders, this means your narrative edge is about speed and precision, catching the market in the moment it realizes something new. For swing traders, it's about endurance, holding through the noise, because you know the deeper current hasn't run its course. Both can be profitable, but only if you see how they connect, like 2 different levels of the same mine. And here's the beauty. When you understand the full arc of a narrative across time frames, you can play both games. You can mine the surface gold with quick trades while keeping your claim staked on the deeper vein. That's how Massey multiplied his returns, not by choosing between day or swing, but by letting the narrative feed both. But spotting these time frames in motion still depends on one thing: your ability to piece together scattered clues into a coherent map before anyone else. And that brings us to the real magic of Massey's approach: information arbitrage. Most traders think the market is a level playing field. Everyone gets the same news at the same time. That's a dangerous illusion. In reality, the market is a constantly shifting web of information, released in fragments, scattered across places most people never look. The advantage doesn't come from having secret, illegal intel. It comes from being able to collect those scattered pieces faster and connect them before the rest of the world realizes they belong to the same puzzle. For Masi, this was the real gold. He didn't have insider tips. He had an obsessive curiosity. Long before NVDA became the AI poster child, he was following breadcrumbs that others ignored. Obscure government press releases about infrastructure grants for AI data centers worth $2.4 billion, patent filings hinting at new GPU architectures with 70% efficiency gains, small supplier contracts that pointed toward a major production ramp of 150% quarter over quarter. Each clue on its own was meaningless to most traders, but to Masi, they were flashing beacons pointing toward the same destination. Here's a question that might change how you research. What information sources do you check that 95% of other traders ignore? If you have a unique source, don't share it. Just type secret weapon. If you only check the obvious places, type expanding now. There's no shame in starting where you are, only in staying there. In real-time trading, this kind of synthesis is a weapon. For swing traders, it means you can position yourself weeks before the catalyst is public knowledge. You're in the mine before the rush, digging where the vein will run deepest. For day traders, it means you can react within minutes to the moment when those scattered clues finally converge into a headline the market can't ignore. While the crowd is still reading the first sentence of the breaking news, you're already in the trade because you saw it coming. But here's the key. Information arbitrage isn't about chasing every shiny object. It's about filtering. 90% of what you see will be noise, meant to distract you from the real signal. The skill lies in recognizing when the dots connect in a way that changes the story, not just adds another chapter. Masi didn't act on every rumor or minor announcement. He built a conviction list, companies and themes worth tracking, and only moved when a critical piece fell into place. Picture yourself with a dashboard of carefully selected information streams. Not overwhelming, not chaotic, but precisely tuned to catch the signals that matter. Government contracts, patent filings, job postings, supply chain shifts, conference presentations, insider transactions, each stream filtered for relevance to your narrative thesis. And this edge works in both directions. Sometimes the fastest money is in realizing when the story is breaking down before the market does. Just as the first clues can point to a surge, they can also signal a collapse. Spotting the cracks in the narrative early lets you exit before the stampede, or even flip your position and profit from the fall. The danger, of course, is mistaking fool's gold for the real thing. Day traders risk jumping into headlines that fade within hours. Swing traders risk holding on to narratives that quietly die while they're still waiting for the payoff. That's why the next step in Masi's process isn't about finding more clues. It's about refining the timing of the strike, using technical confluence as the final green light before he starts digging in. Chapter 6. Technical Confluence for Entry. Even with the richest story in the world, Masi never swung blindly. The narrative told him where to dig. Technical confluence told him when. Without it, you risk swinging your pickaxe too early, wasting energy while the vein is still too deep. Or worse, striking after everyone else has already drained it. For NVDA, the fundamentals were screaming opportunity months before the crowd caught on. But Masi didn't pile in the moment he connected the dots. He stalked the trade. On the daily chart, he watched for price to approach a major level of interest, zones where institutional buying had stepped in before, specifically the 102 to 105 range where volume had spiked 280% above average on 3 separate occasions. He overlaid this with moving averages flattening and curling up, the 50-day finally crossing above the 200-day, a sign that momentum was shifting beneath the surface. But here's where he blended the art of swing and day trading. Once the daily chart confirmed the structure, he zoomed into the intraday, 4-hour, 1-hour, even 15-minute charts. He was looking for the spark, a breakout on volume exceeding 2 times the 20-day average, a shift in order flow showing buyers absorbing sellers at a 3-to-1 ratio, a rejection from a key support that turned into aggressive buying. This multi-time frame stalking meant he could enter with precision, low enough risk for a swing, but with the ability to take partial profits quickly like a day trader if momentum burst immediately. Visualize your own perfect entry setup right now. What would need to align on multiple time frames for you to say, this is it, this is where I strike? The daily structure, the hourly momentum, the 15-minute trigger, when all 3 line up with your narrative, that's when confidence peaks. Technical confluence isn't about overloading your charts with indicators until it looks like a Jackson Pollock painting. It's about aligning a few trusted tools until they all point in the same direction. For Masi, it was structure, volume, and momentum, nothing more. When all three lined up with the narrative, he knew the gold vein was close enough to reach. And just as important, he had his exit plan before he entered. If the intraday structure broke below the 1/850 level or the daily setup failed to hold, above the 21-day moving average, he'd step back without hesitation. The mine would still be there later. There's no sense in breaking your tools on the wrong rock. This discipline, waiting for the technicals to align with the story, meant he didn't waste capital on false starts. It also meant that when he did strike, he could swing hard with confidence. Because in trading, as in mining, there's no prize for being the guy who almost hit the gold. But even with the perfect entry, there's another trap waiting, one that destroys more traders than bad analysis ever could. It's the dual challenge of maintaining patience while fighting the urge to exit too early. And mastering both is what separates the amateurs from the professionals. Chapter 7. The Art of Staying In. Patience is the most underrated form of aggression in trading. It's not about doing nothing. It's about holding your ground while the market tries to shake you out. In the mine, it's the decision to keep drilling even when the first few swings hit nothing but rock, because you know the vein is still there. For Masi, patience wasn't passive. It was active resistance against every instinct screaming to take the quick win. In the early days of his NVDA position, the price didn't explode right away. It crept from 108 to 112, pulled back to 106, crept again to 115, then dipped to 109. Any trader without the story and the conviction would have cut for a small profit or even a scratch. But Masi understood the life cycle of a narrative. It needed time to spread, time for institutions to accumulate, time for the story to travel from niche circles to the mainstream. Think about your worst patience failure. That trade where you sold for plus 2% and watched it run to plus 20% without you. Feel that regret? Now imagine having the tools to never feel that again, not through hope, but through understanding exactly why patience pays in specific setups. The market punishes impatience brutally. Sell too early, and you miss the richest part of the move. Taking profits feels good. It's a quick hit of dopamine, a reassuring pat on the back that says, you did it, you were right. But in trading, that same hit can rob you of the very moves that make all the grind worthwhile. The early exit syndrome is like finding a gold vein, pocketing the first few shiny flakes, and walking away while the rest of the treasure lies untouched. Masi understood this trap all too well. In the NVDA trade, there were moments when his position was up 25%, then 40%, tempting him to lock it in and move on. But he also knew the difference between a trade that had played out and one that was just playing out. The narrative was still young. The institutions were still accumulating, with dark pool activity showing consistent buying above 120. The public had barely begun to notice. Selling then would have been like shutting down the mine after the first truckload. Imagine watching your position grow from plus 10% to plus 15% to plus 25%. Feel that voice saying, take it now, before it disappears. Now imagine having a framework so clear that the voice becomes irrelevant. You know exactly when to hold and when to fold, not based on fear, but on evidence. Quick engagement check. Have you ever sold a winner too early and kicked yourself for weeks? If yes, what percentage of the move did you miss? Drop a number in the comments, 50%, 100%, 200%. You're not alone, and more importantly, it's fixable with the right approach. Masi fought this by defining his exits before the entry. He had target zones based on technical levels, narrative milestones like earnings beats exceeding 30%, and market psychology. If none of those targets had been reached, then taking profits early wasn't discipline, it was sabotage. This approach turned the decision to hold from an emotional battle into a mechanical one. He also scaled out strategically. Rather than dumping the entire position at the first sign of green, he'd take 25% off at the first target, another 25% at the second, and let the final 50% run with a trailing stop. That way, he reduced risk without cutting off potential. But patience isn't endless. You have to know the difference between a trade that needs time to ripen and one that's rotting in your hands. That's why Masi always balanced patience with clear criteria for when the trade no longer deserved it. If the narrative broke, if demand projections missed by more than 20%, or the technical structure failed with a close below the 50-day moving average, he'd exit without regret. The early exit syndrome is driven by fear of losing gains, fear of being wrong after being right. But the cost of that fear is often invisible. You don't see the profits you never made. You don't feel the weight of the missed opportunity. The only way to break it is to anchor your decision to the story and the structure, not to the fleeting comfort of locking in a small win. Because in trading, the biggest moves rarely reward the first one out of the door. They belong to the trader who can stay in the mine long enough to reach the real gold. And staying that long requires more than patience. It requires knowing exactly when to hold through volatility, and when the story itself has changed. Chapter 8. Knowing when to hold, knowing when to fold. Volatility is where most traders lose their nerve. A sudden red candle wiping out 8% in minutes. A sharp pullback erasing 2 weeks of gains. A spike in volume against your position reaching 5 times normal. It's enough to make even seasoned traders hit the eject button. But for Mazi, these moments weren't signals to abandon ship. They were stress tests. And the only reason he could pass them was because he carried something most traders lacked: conviction rooted in evidence. Conviction isn't stubbornness. It's not about digging your heels in because you believe in a stock. It's about building such a strong, evidence-based understanding of the narrative that market noise can't shake you. When NVDA dropped sharply from 142 to 124 in 3 days in the middle of its run, plenty of traders bailed, congratulating themselves for protecting capital. Mazi stayed put. Why? Because nothing about the core story had changed. Demand for GPUs was still rising, with back orders extending from 3 months to 5 months. AI adoption was accelerating, with enterprise inquiries up 400% year over year. The catalysts were still in place. In his eyes, the gold vein was still intact. The market was just kicking up dust. Picture yourself in that drawdown, your account showing red, down 12% from recent highs. The news is negative, analysts are worried, your friends are telling you to sell. But you have the data, you have the thesis, you have the conviction. That knowledge transforms panic into opportunity. But conviction isn't blind. Mazi had clear criteria for when his shield would drop. If the data that built his case started to crumble, if the demand drivers disappeared, if GPU sales declined quarter over quarter, if the technical structure broke decisively with a weekly close below the 200-day moving average, he'd walk away. The difference was, until that point arrived, he didn't let volatility dictate his actions. There's a strange thing that happens when you trade with true conviction. You stop reacting to price and start responding to the story. You know the difference between a shakeout and a breakdown, between noise and signal. You stop flinching at every swing of the market's hammer because you know exactly what you're mining and why you're still there. And yet, even the strongest conviction can't protect you forever. Every narrative has an expiration date. The market doesn't send you a polite email to let you know. It shifts quietly at first, then suddenly, leaving latecomers and overconfident holders stranded. For Mazi, recognizing when the story changes is just as valuable as spotting when it begins, because getting out early can be the difference between banking profits and giving them all back. In the NVDA trade, he was constantly testing the story against reality. Were the AI adoption metrics still climbing? Quarter-over-quarter growth had been 45%, 52%, 48%. But what if it dropped to 15%? Were key contracts still being signed? Was the competitive landscape still favorable, or were AMD and Intel closing the gap? The moment those fundamentals began to stall, the clock on the narrative started ticking. In mining terms, it was like hitting more rock than gold with every strike. It meant the vein was thinning. Feel into this moment. You've ridden a trade from 100 to 250. Everyone's euphoric, calling for 500. But you see the cracks, slowing growth, increasing competition, technical distribution. Do you have the discipline to walk away while others are still celebrating? That's the difference between professional and amateur. Mazi had a checklist for exits, a break in the core thesis, a loss of key technical structure like falling below the 50-day moving average on increasing volume, or a shift in sentiment that signaled the narrative was no longer aligned with reality. If any of those hit, he didn't wait for confirmation from the crowd, he stepped out, sometimes even flipping to the other side if the reversal was strong enough. The discipline to leave while the party's still going is rare. Most traders need the market to prove them wrong before they act, which usually means the damage is already done. Macy preferred to leave with the mine still producing, rather than risk staying until it collapsed. And here's the paradox. The better you are at spotting the start of a narrative, the more tempting it is to overstay. That's why the next piece of his playbook is designed to lock in gains while still giving the story room to run, scaling in and out with precision. Chapter 9. Scaling in and out with narrative clarity. Inexperienced traders think position sizing is just about how much risk you can stomach. For Massey, it was a living, breathing part of the trade, a way to shape his exposure as the story unfolded. Scaling in and scaling out wasn't random. It was tied directly to the strength and maturity of the narrative. When NVDA's story was still in its infancy, Massey didn't go all in. He started with 20% of his intended position size, staking an initial claim in the mine, enough to profit if the vein was rich, but not so much that an early dry patch would break his tools. As each narrative milestone hit, an earnings beat of 35% versus expectations, a confirmed contract worth $1.2 billion, a spike in industry demand showing 180% year-over-year growth, he added. But these weren't emotional ads. They were planned escalations, backed by both the story and technical confirmation. Imagine building your position like constructing a pyramid. The foundation is small but solid, built on initial conviction. Each layer added only when the structure below proves stable. By the time you reach full size, you're not hoping, you're knowing, backed by multiple confirmations. Swing traders can use this method to pyramid into winning trades over weeks or months, turning a modest starting position into a major winner without ever taking oversized initial risk. Day traders can apply the same logic intraday, adding size when the catalyst strengthens and order flow confirms with buyers stepping in at increasingly higher prices, then scaling out as the move matures. And just as important as scaling in is knowing how to scale out. Massey didn't wait for the absolute top. He peeled off portions of his position into strength, banking 25% at plus 50%, another 25% at plus 100%, final portions at plus 200%. This approach satisfied both his need to protect gains and his desire to capture the full potential of the narrative. Scaling out also acted as a psychological buffer. By locking in some profits, he could let the rest of the trade breathe without the constant urge to grab it before it's gone. This reduced the risk of panicking during volatility and allowed him to follow his plan to the letter. But scaling is only as effective as the timing behind it. Do it too soon, and you clip your own upside. Do it too late, and you give back too much. That's why the real magic happens when scaling meets opportunity. Like those rare moments when a fresh narrative erupts intraday, offering the kind of plays that can turn a single session into a month's worth of profits. Chapter 10. Intraday Narrative Plays. Some narratives take months to unfold. Others ignite and burn bright in a single trading day. These are the moments day traders live for. The sudden emergence of a story so compelling, so explosive, that it changes the entire tone of the market within minutes. Massey didn't just hunt for these. He was ready for them. His watch lists weren't random collections of tickers. They were a living archive of potential catalysts, companies and sectors that could light up the tape if the right spark landed. Biotech companies awaiting FDA decisions, tech firms in final stages of major acquisitions, retailers before earnings, with whispered numbers 40% above consensus. And when that spark hit, he already knew the context, the players, and the likely path the narrative would take. Consider the biotech stock that surges on unexpected FDA approval, jumping 180% in pre-market, or the small cap tech company that lands a surprise government contract worth 5 times its market cap. The moment the news drops, the clock starts ticking. Liquidity floods in, with volume hitting 20 times average in the first hour, spreads tighten from 50 cents to 5 cents, and volatility skyrockets. The difference between a rookie and a pro in these moments is preparation. While the crowd scrambles to understand what's happening, Macy is already assessing whether the story has legs. Does it align with a bigger theme? Is this the start of a new vein, or just a glint of fool's gold? Picture yourself ready for the next explosion. Your scans are set, your levels are marked, your plan is clear. When the news hits, you're not scrambling to understand, you're executing with precision. How different would your trading be with that level of preparation? If the answer was yes, he moved fast. Entries came on the first clean pullback after the initial spike, typically at the first retest of breakout level, with volume confirming support, with tight risk controls keeping stops within 2%, and a clear plan for scaling out into the inevitable surges. These trades weren't about buy and hope. They were about precision, timing, and knowing exactly when the momentum would likely fade, usually at psychological levels, or when volume dropped below 50% of the opening surge. And here's the connection to swing trading. Intraday narrative plays can be the first chapter of a much bigger story. A day trade that starts on a breaking headline might evolve into a swing position if the catalyst fits into a larger trend. Mazzi used intraday action not just to capture immediate gains, but to scout for narratives worth holding beyond the close. But whether the play lasted 20 minutes or 20 days, the principle was the same: align speed with story, and never let excitement override the plan. Because while a sudden narrative can make your month, it can also wreck your week if you're on the wrong side when the music stops. Spotting these short-term eruptions is thrilling, but to truly master the narrative edge, you have to see the story in its full environment. And that means zooming out, way out, to understand how the broader market climate can supercharge or suffocate even the best story. Chapter 11. Combining narrative and macro. A great story can drive price, but the market's larger climate decides how far and how fast it can run. Even the richest gold vein is worthless if the ground around it is too unstable to dig. That's why Massi never looked at a narrative in isolation. He always framed it within the broader macro picture. When NVDA's AI story was unfolding, it wasn't happening in a vacuum. Interest rates moving from 5.5% to potentially 4%. Inflation data showing tech-friendly trends with core CPI dropping to 3.2%. Fiscal policy allocating $280 billion to technology infrastructure, and sector rotations showing money flowing from financials to tech at the highest rate in 5 years, all shaped the environment. Mazzi knew that even the most compelling micro story could stall if the macro backdrop turned hostile. He tracked the Federal Reserve's tone, watched the bond market for shifts in risk appetite with the 10-year yield as his key indicator, and monitored sector ETFs for signs of capital flow, particularly XLK versus XLF ratio. If the macro aligned with his narrative, say, a tech-friendly policy shift or an easing rate environment, it acted like oxygen to a flame. If it didn't, he adjusted his expectations and his sizing accordingly. For swing traders, this macro awareness helps you ride the bigger waves instead of paddling against the current. It tells you when to press your advantage and when to tread lightly. For day traders, macro still matters. Intraday liquidity and volatility often spike or vanish based on news events, economic reports, or sudden changes in sentiment tied to the bigger picture. Knowing when these events are coming lets you position ahead of the crowd, or, just as importantly, avoid being blindsided. Macy treated macro as the climate and narrative as the weather. You can have a sunny day in the middle of winter, but you'll get further if your journey starts in the right season. This perspective allowed him to filter out narratives that might look promising on the surface but had no chance of gaining real traction in the current environment. Feel how much stronger your conviction becomes when both micro and macro align. It's not just this company has a good story, it's this company has a good story at the perfect time in the perfect environment. That's when outsized moves happen. The combination of narrative and macro created a layered conviction, one that could survive temporary volatility because it was rooted in both the micro and the macro storylines. And when the two lined up perfectly, the results were exponential. That alignment often spilled over beyond single stocks, creating opportunities not just in one name, but across entire sectors moving in unison. Chapter 12, From Single Stock to Sector Momentum. When a narrative is powerful enough, it doesn't stay confined to a single ticker. It spills over, igniting an entire sector. What started as a solitary gold vein becomes a sprawling network of interconnected tunnels, each one offering fresh opportunities to mine. Mazzi knew that once the market latched onto a theme, the momentum could rotate rapidly between related names, creating a chain reaction of trades. NVDA's AI boom was a perfect example. As the story caught fire, capital didn't just pour into NVDA, it spread to suppliers like Taiwan Semi up 45%, software companies like Palantir up 180%, cloud infrastructure providers like Amazon's AWS division driving 30% revenue growth. Even obscure component manufacturers whose products suddenly became AI-related in the eyes of traders, with some penny stocks surging 500% purely on association. This sector-wide momentum was a gift for both swing and day traders. Swing traders could diversify exposure, building a basket of 5 to 7 positions to ride the wave over weeks or months. Day traders could surf the intraday rotations, jumping from one hot name to another as volume shifted from leaders to laggards in predictable patterns. The key was mapping the ecosystem early. Mazi built watch lists that linked directly to the core narrative, knowing which companies were direct beneficiaries with immediate revenue impact, which were secondary plays benefiting from association, and which were just riding the hype with no fundamental connection. This allowed him to anticipate where the flow would go next, instead of chasing whatever was already extended. Here's where you can level up your own trading. When you spot a narrative taking hold, immediately map the entire ecosystem. Who supplies them? Who competes? Who benefits indirectly? Build that list before the crowd catches on, and you'll have targets ready when rotation begins. Take a moment now. What sector is showing early narrative formation that you could map today? Sector momentum also offered a way to scale opportunity without overexposing to a single name. By spreading positions across multiple tickers within the same theme, he could capture the macro move while reducing the risk of being blindsided by company-specific news. But just as sector momentum can multiply gains, it can also accelerate losses when the tide turns. When the narrative that fuels a sector begins to fade, the entire group can unwind together, erasing weeks of profits in days. That's why Macy's final step in the process is perhaps the most important, building a repeatable system for finding, exploiting, and exiting these gold veins before they dry up. Chapter 13. Building Your Own Narrative Edge. The beauty of the narrative edge is that it's not magic, it's method. Macy's success wasn't the result of one lucky trade, it was the product of a repeatable process that anyone willing to put in the work could build for themselves. The mine isn't hidden, it's just ignored by most traders because they're too busy chasing shiny objects in the open pit. The first step is identifying potential narratives before they're obvious. This means tracking industries, reading beyond the headlines and trade publications, government reports, academic papers, and keeping a running list of companies and sectors that could be one catalyst away from ignition. Then comes the research, digging deep into fundamentals, connecting seemingly unrelated dots, and forming a thesis strong enough to withstand the inevitable pullbacks and skepticism. Next is timing, waiting for technical confluence to confirm that the story is catching traction in price action. This patience ensures you're not just right in theory, but positioned to profit in reality. Once you're in, your job shifts to managing conviction, holding when the story is intact, exiting when it breaks, and scaling in or out as the narrative strengthens or weakens. Imagine yourself 6 months from now, having mastered this process. You spot narratives weeks before they break. You enter with conviction built on research. You hold through volatility because you understand the story. You exit with profits while others are still hoping. For swing traders, this system gives you the confidence to hold through the boring days and the courage to press when the tide turns in your favor. For day traders, it equips you to react with speed when a fresh narrative hits the tape, capturing the most explosive part of the move while avoiding the traps. The final piece is review. Every narrative you trade, win or lose, becomes a case study. What clues worked? Which ones misled you? How could you have entered or exited more effectively? Over time, this feedback loop sharpens your edge until spotting and trading narratives becomes second nature. Massey's gold wasn't just NVDA, it was the skill set he built, the ability to see the story before it became a headline, and the discipline to mine it for all it was worth without letting greed or fear drive him into the wrong tunnels. That's the edge you can build too, one narrative at a time. And now that you know how to find these veins, the only question is, will you start digging before the crowd shows up? We've just walked the tunnels together, from spotting the faintest glimmer of a story, to confirming the vein with research, to timing your strike with precision, to knowing when to pack up and leave before the mine collapses. Over the past hour, you've learned the same principles Massey used to turn NVDA into millions before the hype even began. You now know how to identify a narrative before it becomes mainstream, build conviction through deep targeted research, time entries with technical confluence across multiple time frames, harness patience to hold through noise and shakeouts, Avoid the early exit syndrome and let trades mature. Protect yourself from volatility with an evidence-backed shield. Recognize when the story has changed and it's time to go. Scale in and out as the narrative develops. Exploit intraday catalysts without getting trapped in the fade. Align micro-story with macro-climate for maximum tailwind. Expand from a single ticker to sector-wide momentum. And build a repeatable personal system for mining future narratives. Now here's where knowledge transforms into action. What's the gold vein you see forming right now? Not what everyone's already talking about, but that story's still in its first chapter. Maybe it's in renewable energy with government contracts accelerating, perhaps in biotech with a breakthrough therapy in trials, or in a forgotten sector about to see regulatory tailwinds. Take 30 seconds right now, think about it, then share it in the comments. But here's the twist. Don't just name the ticker or sector. Tell us one piece of evidence that others are missing. One breadcrumb that led you to this vein. Because explaining your thesis publicly does two things. It forces clarity in your own thinking, and it might just help someone else see what they've been missing. And if you're serious about developing this edge, here's your homework. Pick one sector this week, just one, and spend 2 hours mapping its ecosystem. Every supplier, every competitor, every related company. Build that watch list before the narrative explodes, not after. The traders who win consistently aren't the ones who react fastest. They're the ones who prepared furthest in advance. If this approach to reading market narratives opened your eyes to possibilities you hadn't seen before, hit subscribe and ring the notification bell. Every week on Trading Psychology Stick, we decode the mental models and strategic frameworks that separate profitable traders from the crowd. We don't chase yesterday's moves. We position for tomorrow's stories. But subscribing is just the first step. The real transformation happens when you take these concepts and apply them to your own trading. So, here's my challenge. For the next 30 days, dedicate just 30 minutes each morning to narrative research. Not chart watching, not news scanning, but deep research into stories that haven't made headlines yet. Document what you find, track your thesis, and come back here to share your discoveries. Remember, every legendary trade started the same way. Someone saw a story others missed, believed in it when others doubted, and had the discipline to mine it properly. The gold isn't in chasing where everyone else is digging. The gold is in finding your own vein and starting before the world even knows it's there. The market will open again tomorrow, with thousands of stories unfolding. Most traders will chase the ones already on the front page. But you now have the tools to spot the stories still being written. The only question left is, will you use them? See you in the next video, where we'll dive into the psychology of holding winners beyond your comfort zone. Until then, keep your eyes on the story, not just the price. Trade the narrative, mine the gold, stay ahead of the crowd.